Welcome back. Early today, sales of previously owned homes fell for a seventh straight month. That was reported by the National Association of Realtors, reporting 4.8 million homes versus the estimates of 4.69 million. The median sales price rose 7.7% year over year, but it does mark the second monthly decline. The Federal Open Market Committee raised interest rates today by 75 basis points. That's a third increase in a row. The current Fed funds rate now stands at the range of 3 to 3.25%. Their target by the end of this year is 4.4%. The target for the end of next year is 4.6%. And in the statement, they did indicate that maybe in 2024 we could be looking at Fed cuts. But we're looking at another probably 1.25% interest rate hike for the remainder of the year, obviously depending on economic conditions. Now, first off, the sales of previously of existing homes, the price did rise 7.7% year over year, but the price is declining month over month. This is a second straight decline, and existing home sales also. The number of existing home sales did also decline, and that's a seventh straight monthly decline. So it certainly does indicate that there's a pretty strong trend. Take a look at existing home sales. Over the past 10 months, we've now hit a new low. This is the lowest low we've hit in the past 10 months. Certainly it has wavered throughout the trend, but the overall trend certainly is very, very, very clear, and that is to the downside. The sales price of existing homes, 389,500. That's almost the lowest low. Well, it's going back. It's the lowest low we've seen in about 5-6 months, going back to March of this year, but not that far off the lowest low we've seen over the past 10 months to almost a year now. Taking a look at it from a little bit of a different point of view, we see the existing home sales. Again, it's a decline month over month of 0.41%, and the sales price is down 2%. And you can see that it certainly is an overall trend to the downside. The housing market has been one of the weaker markets in our overall economy. We took a look at this yesterday really quickly. The blue housing index line represents a culmination of the home price index, existing home sales, the sales price, active listings, construction spending, residential construction. The reason why we look at this is because if you go back to 2008, 2009, the big financial recession we saw back then, the blue line, the housing market, did very much participate in that downturn. The red line represents inflation. The green line represents growth. Now, of course, the 2008, 2009 recession, was comprised primarily of a housing market crash. So, this certainly is no surprise. But we want to see, if we want to look for further confirmation that this recession, the technical recession that we're in, 2 negative quarters consecutive of negative GDP growth, if that is real, we want to see confirmation with the housing market index also turn to the downside. It has, but it's certainly not as weak as we've seen it, in the past. Taking a look at the bond market, this is the daily change. The 1-year bond up 5 basis points, a 2-year bond 6 basis points. These are multi-year highs. Notice a 10-year bond down 6 basis points. The 20-year bond down 10 basis points. 10 basis points is 10% of 1 percentage point. So we see capital continues to move out of the short-term bonds, 1, 2, 3-year bonds. As the yield goes up, we know the prices of those bonds go down. As the yields of the longer-term bonds go down, it means those prices are going up. So we see capital is moving out of the short-term into the long-term bonds. And that's a trend we've seen continue to take place, for many, many months now. Taking a look at the red line on the top right-hand side, that is the total bond yield. If you add up all the different interest rates of all the different maturities, we see a very strong trend to the upside. The blue line represents the S&P 500. A lot of weakness in the stock market today, down about 500 in the Dow. The green line in the center of the chart represents the net bond spreads. It's hovering near the low. And then this represents the spread between, let's say, the 30-year and the 20-year, the 20-year and the 10-year. In a so-called healthy economic climate, we want to see that the spreads increase where the 30-year bond pays a significant much more than the 20 and the 20 more than the 10 because traders want to buy those short-term bonds because they have optimism about the near-term future. We see the opposite taking place. What's very interesting now is we see correlations between the S&P 500 and the spreads of, I would call them the medium-term bonds. The 10-7 spread, meaning the difference between the 7-year and 10-year maturity bonds, that spread is moving in the same direction as the S&P 500. It's an 86% correlation. The 7-5 spread, the difference between the 7-year maturity, 5-year maturity, those spreads are compressing. We see traders are continuing to get out of the short-term bonds and ratchet up to a little bit more of the longer-term bonds. So they're selling the 2s, they're buying the 3s. They're selling the 3s and buying the 5s. They're just ratcheting their capital more towards the long-term bonds. So take a look at the correlations that exist. We see here the black line is the S&P 500. The yellow line is the 10-7 spread. It's negative territory, as we can see over here. So it's almost a 14 basis point inversion. What traders are doing is they're selling the 7-year bond, buying the 10-year bond. The same kind of correlation also takes place with the 7-5 bond, the 7-year and 5-year bond. Notice the S&P 500 go down, so does the spread, the difference between the two. What these spreads show is not the movement of the bond so much, but the flow of capital. Capital is moving out of the longer term maturity, or out of the shorter term maturity, I should say, into the longer term maturity. Out of the 3 into the 5. We can see here out of the 2 into the 3. And that's a trend that's continuing to take place. It's the opposite of what we'd like to see under a strong economic climate. So this is just more confirmation that the bond market is moving in the same direction as the stock market, to the downside. Now, the yellow area chart is the S&P 500. The green line represents the culmination of the short-term bond spreads. We continue to see these things really propel higher. If you consult or if you take a look at our video from yesterday, we did not see as sharp of an incline as we do today. Same holds true from the blue and the red lines. That's the long-term and medium-term bond spreads. Those continue to decline and accelerate lower. So there's just more confirmation of what we've seen in the past. Remember, back in June, the green line spiked higher. S&P 500 moved very sharply to the downside as capital moved out of the short-term bonds, looking for safety with a little bit longer-term outlook. So, and finally, we wanted to take a look over here. The gray lines, the gray bars, I should say, represent the 30-day percentage change of various different financial markets we watch, everything from crude oil and other commodities to cryptos to equity markets. The number one performing financial market over the past 30 days has been the NASDAQ Volatility Index and the VIX, which is the S&P Volatility Index. The NASDAQ Volatility Index, month over month, or actually not month over month, but over the 30 past days, is up 29%. The VIX, which represents the price of options on the S&P 500, is up 38%. Now, the VIX, you'll notice, is at a level of 27. 27 is not a level that we'd consider to be danger. Usually the VIX during strong markets is around 10 to 15. When we hit very weak markets, when the stock market really goes down very quickly, it'll be above 40, maybe even 60. During the stock market crash of 2019, the VIX hit a high, I believe, around 80 or in that area. So readings under 40 are not considered to be oversold yet. Point being is that the stock market, I believe, should still have, at least according to the VIX, more room to the downside. I don't think we've hit any sort of technical bottom yet. And we can see Ethereum also is one of the weaker financial markets out there as well. S&P 500 as well. So we see a flight to safety, a flight into options. Traders tend to buy options to either hedge their bets or to buy some sort of protection, and that's why the premium on the options on the NASDAQ volatility or the NASDAQ 100 or on the S&P 500, those tend to go up. The premium of those options tends to go up when stocks go down. And that's exactly what we see right here. Taking a look at the RSI on the top left-hand side, over here we see every dot represents one component in the S&P 500. And this is plotting each stock with its own respective RSI. And we can see the vast majority of these stocks have an RSI reading of between 25 to around 45. Readings below 50 are considered weak. Now, readings below 30 can be considered oversold. Most of the stocks are not below 30. Take a look at the right-hand side. On a histogram bar, it shows us the count. For example, we have 122 stocks with an RSI reading of 40 to 45. We have another 113 stocks with an RSI reading of 35 to 40. We have between 45 to 50 on the RSI. We have 100 stocks. So the vast majority of the stocks are between the 35 to 50 area, but very few are below 30. There's actually only 11 stocks with an RSI of 25 to 30 and even less below that. So point being is RSI is telling us we're not yet in a technical oversold area. We will be when the stocks start to breach below the 30 level. Now, not every stock may go below 30, but the vast majority of the stocks are still in a long-term, it looks like trend to the downside, but not very oversold yet. The green charts at the bottom show us the same S&P 500 components, but this time in respect to their 52-week range. So we have a scale of 0 to 100, and if we imagine there's a stock that has a 52-week trading range of $1 to $100 a share, the vast majority of these stocks are, $25 a share, $30 a share. They're grouped near the lower end. But compare that to the RSI. The RSI is very tightly grouped near the lower end between, again, 25 to 50. The 52-week range, it's a little bit more equally spread out, but definitely clumping more near towards the bottom. But take a look at the histogram picture of this same picture. We see 73 stocks within their own respective 52-week range are at the 5 to 10 percentile area, meaning 0 to or $1 to $100 a share. 73 stocks are trading, if you put it in that scale, around $5 to $10 a share, right near their lows. There's another 49 stocks that are trading within the 10 to 15% bracket of their 52-week range. So this tells us a very interesting story, and we've seen the story before, but it really is kind of continuating and accelerating, that while the vast majority of the stocks in terms of their relative strength are weak but not yet oversold, they are trading, the vast majority of the stocks are trading right near their 52-week lows. Of course, stocks can make new 52-week lows, and I would suspect that if we see the market, really start to accelerate to the downside, and the stocks start to break their 52-week lows, we'll see that coincide with the RSIs of a lot of these stocks start to break below 30. So, for the stock trader out there, I think that we want to make lists of stocks that we think have a lot of value, but I think it's a little early, at least based on what the technicals are telling us, to get in these stocks, because while they're weak, they're not yet very oversold. It's not an exponential move yet. Not according to the RSI, not according to the 52-week components, not according to the VIX, the volatility index. We're only around 27 right now. As far as the bond market, it's a little bit harder to read because, these short-term bonds, a lot of them, the 1-year, 2-year bonds are making multi-year highs. So we really don't have, I believe, maybe 15-year highs if I remember correctly. So we don't really have as an fair of a judgment as far as when these bonds may be considered to be overbought, or in the short-term bonds oversold, where the yields have just gone up so high. But we're looking for confirmation from several different markets to tell us that we've hit a bottom. I personally don't think we're there yet, but certainly the trend is your friend. Next week we have durable goods. We certainly have a lot of other very interesting numbers coming up. Durable goods next week, S&P K Schiller, that's going to be next week as well. Oh, I'm sorry. Yeah, S&P K Schiller home price index will be next week. Consumer confidence, pending home sales next week. We have some GDP numbers as well. So we certainly have a lot that could propel the market one way or the other. But as far as the Federal Reserve is concerned, they raised 75 basis points. We may have another 125 to go, but it'll be very interesting to see how all this plays out. We thank you for joining us. We look forward to seeing you back soon.